Yeah, I would say that in terms of the index fund, I would just take a very broad index. I would take the S&P 500 as long as I wasn't putting all my money in at one time. If I were going to put money into a index fund in relatively equal amounts over a 20 or 30 year period, I would pick a fund, and I know Vanguard has very low costs. I'm sure there are a whole bunch of others that do. I just haven't looked at the field.
I'm dollar cost averaging into the index funds every day. So every day the market's open, it's a habit of mine to wake up every morning and to buy the same dollar amount every single day.
How much is that every day?
$5,000.
Dollar cost averaging is, in one sense, not a particularly productive idea.
DCA, dollar cost averaging, is an investing strategy of dribbling small amount of money, typically the same amount, into the stock market over a period of time, as opposed to a one-off lump sum investment. And this method is widely used for passive broad market index fund investing. But I'm afraid to say, we might all been doing it wrong. Dollar cost averaging may not be the best way to invest, especially if you just receive a big cash windfall. And there's a better way to invest. The theory behind DCA is that you try to shine away from the market timing risk of investing in a single transaction on what might be an expensive entry point. In other words, if you invest a lump sum on a day when the market is up, you will purchase fewer shares than when the market is lower. By adopting a dollar cost averaging strategy, you can spread out your investment entry points. Some days you get more shares, some days less, and potentially achieve a lower average cost base. Dollar cost averaging has many attractive benefits, such as it prevents procrastination. Many people have a hard time getting started investing, and dollar cost averaging is a no-brainer way to provide discipline for investors. It can also remove the emotional side of investing. As we invest a certain amount of money each month, normally it's when we get paid. This eliminates the temptation to engage the market timing and saves our time as well. And dollar cost averaging also reduces our stress level. It can minimize the regret of bad timing since you make multiple investments with none of them being large amounts. Technically, all working Australians use dollar cost averaging within our retirement superannuation accounts each month, but dollar cost averaging doesn't always play out neatly.
Dollar cost averaging is, in one sense, not a particularly productive idea. And that is to say, if you've got, say you come into $1 million from your nice deceased aunt and decide you will average into the dollars, you'll probably do better most of the time. Nothing is universal if you invest it all in the same day. Right. That's the plus, because the longer you hold a stock, the better it tends to do.
First of all, I don't think that we should use this strategy to purchase individual shares. In fact, research from the Financial Planning Association and Vanguard has found that over the very long term, dollar cost averaging can underperform lump sum investing. Schwab Center for Investment Research has published a paper on this topic as well. It considered the situation of 5 hypothetical investors who got a $2,000 bonus check each December 31st and invested in the S&P 500 index fund during the 20 years from 1978 to 1998 without any selling. And person A, Peter, was the perfect market timer. He has incredible skill and luck, therefore had managed to place $2,000 into the index fund every year at the market's lowest monthly close price. And person B, Ivy, invested immediately. She invested her $2,000 in the S&P 500 index fund at the earliest possible moment once she received her cash. And person C, Ben, was a bad timer. He tried to time the market but with incredibly bad luck. He happened to invest each $2,000 at the market's highest monthly close price. And person D, Nancy, never invested. She was scared to take the risk of the stock market and had left her money in treasury bills every year. Person E, Dawson, believes dollar cost averaging can help him avoid the market timing risk. He divided his annual $2,000 allotment into 12 equal parcels, which he invested in the S&P 500 index fund at the end of each month. And the uninvested balance was kept in treasury bills. If we see how much wealth each investor accumulated at the end of the 20 years, naturally, Peter, the perfect timer, accumulated the most with $370,000. And Ivy, who invested immediately, surprisingly came in second with $20,000 less than Peter, considering she had simply put her money to work as soon as she received it each year without any guesswork or timing at all. Even the bad timer Ben accumulated $234,000 more than Nancy, who never invested, which is very encouraging result. And investor E, who used dollar cost averaging approach, resulted in the third place ranking with roughly $10,000 less than Ivy, who invested immediately. While you may say this 20 years period of timing may have favored investor A, B, and E, the Schwab Center also analyzed all 54 rolling 20-year periods dating back to 1926. That is to say, from 1926 to 1945, 1927 to 1946. In 44 out of the 54 periods studied, the ranking was exactly the same. If we look at this table, if the 20-year period, there were occasionally some exceptions to the expected rankings, such as during 1955 to 1974, Nancy, who invested in the treasury bills, would have accumulated the most wealth. This was mainly because the stock market had a couple of small dips and corrections due to the 4 recessions during that period. Schwab also looked at all possible 30, 40, and 50-year periods starting in 1926. And there were no this type of occasional exceptions to the expected rankings. This means that in every 30, 40, and 50-year period, perfect timing was always first, followed by invest immediately, dollar cost averaging, bad timing, and never invest. Statistically speaking, no matter how hard we try, we probably wouldn't be the perfect timer or the bad timer. And we don't want to be like Nancy, who missed a tremendous opportunity in the stock market to build wealth simply because she procrastinated to get started. So let's focus on the investing strategy of dollar cost averaging versus investing immediately, or some people call it lump sum investing, LSI. From the comprehensive research done by Schwab, clearly we can see DCA doesn't make us wealthier when we look at investing in the S&P 500 index fund, which goes uptrend in the long run. You may argue that, of course, investing immediately as early as possible would accumulate more wealth than dribbling money into the market because the market is going up eventually. But would you invest in an asset that is going down in the long run, either using lump sum investing or dollar cost averaging strategy? Probably not. So there is an unspoken assumption that we're talking about investing in a broad market index fund which goes up in the long run, LSI or DCA. So under this assumption and the research result, DCA doesn't make us wealthier than the LSI. Still not convinced? We can see another research done by Morningstar. The authors compare 4 scenarios of the end total wealth of using LSI and DCA if $100,000 cash windfall was received and invested for the 10-year period of time. Scenario number 1, invested in June 2008, investing right before the global financial crisis. And number 2, in June 2009, investing at the bottom right after the global financial crisis. Number 3, in the 1970s lost decade when the stock market was going nowhere due to the slow growth of the economy. Number 4, in the decade of 2000, during which there were 2 bear markets. LSI outperformed DCA in both stock-only portfolio and 60-40 stock bond portfolio 1, 2, and 3. Only during the tech bubble, DCA won out for the stock-only portfolio. However, the 60-40 portfolio still benefited from the LSI strategy, outperforming the DCA approach by 6%. Now that we're clear that most of the time, lump sum investing would provide a better return than dollar cost averaging. And I would also argue that DCA doesn't take our attempt to time the market away either. Why? If we receive a cash windfall, it could be a big bonus from work, a hefty dividend that needs to be reinvested, the sale of assets due to the rebalancing of the portfolio, the sale of a property, or it can be an inheritance. You name it. Say $50,000. What might stop us from going all into the broad market index fund? We might think,
what if the market goes south tomorrow? Why do I have to have a bet on the market by going all in at once? Market goes up and down. I want to catch some low entry points by doing dollar cost averaging.
But do you realize by thinking like that, we're trying to predict how the market will perform? We're timing the market. So instead of shying away from timing the market, we are in the trap doing exactly that. According to the same paper from Morningstar, the returns of dollar cost averaging are more uncertain than the lump sum investing returns. In other words, dollar cost averaging is more riskier than lump sum investing. So if you do have a large sum of money, you're generally better off investing it as soon as possible. It can be stressful to invest a lot of money at once as it is psychologically counterintuitive. In order to sleep well at night, maybe it's better for you to invest portions of a large sum over time. And don't worry, dollar cost averaging still helps our money grow. It just grows slightly less than lump sum investing mathematically. But I don't have a cash windfall and I'm investing $2,000 every month after I get paid. Something I should change? Well, what you're doing is kind of like a combo of lump sum investing and dollar cost averaging, and you're investing as soon as you get the money. So you are investing immediately. So all good. If you're still watching now, you may be interested to know what to invest in such a high inflation environment. Here is a video to check it out after this one. My name is Irene. I'll see you next week. Bye.